I love gold. I love silver from the Austrian, the economics. Like that appeals to me. That the Austrian economics, all that sound money stuff. It appeals to me from inside. But at the end of the day, I'm not going to be long gold and silver until silver breaks out above. Now it's a descending trend line, so it needs a close above maybe 26, 27. We could go in details later. I could show a chart, the specifics of where I think when it breaks out. That's when you wager your actual own money. You don't have to be invested, even if you believe in a story. Let the story there. It's beautiful. Talk about it with your friends, everybody. You don't have to put your money until the chart tells you, okay, it's time. It's like these guys, they've been proning gold and silver forever. They could be right in the storytelling department, but in the charts, you shouldn't have been in gold or silver post 2012 when SPX was breaking out versus Producer Price Index versus gold. You shouldn't have been in those. You should have taken a hiatus. You should have went long all these tech stocks and make these great returns. Because I remember back in 2009 or 10, everybody was waiting for the implosion of tech stocks. To have a precious bull market, you need gold to outperform the SPX. And if I overlay the silver chart to the gold to SPX ratio, I overlay the oil chart, uranium chart, any miners, practically all miners, they track gold able to siphon capital flow. So let's say there's the M2 or whatever money supply. If gold is able to take more money supply than SPX and outperform SPX, then all these instruments in the precious metals complex and the commodity complex will have tailwinds instead of headwinds. Gold needs to break out versus SPX. If gold is able to uptrend versus SPX, we're all going to look like geniuses. All of us, even the guys with crappy mining company stocks, they're going to look great, guys. So this is what we have to wait for. We need to make sure that and this is another thing about ratio charts. This ratio could be going up with SPX also going up. And there's a high likelihood that once gold breaks out versus SPX, it's not because gold is going up by itself or because SPX is going down necessarily. It might happen at the beginning of the bear market or the crash that gold gets up, SPX goes down. What's actually probably going to happen is gold and SPX will be going up together, but gold will be going up faster. So if something's going up faster than something else, you want to be in that fastest horse. I don't care how much you love the story of the SPX, you love the story of Coca-Cola, whatever, you want to be in the fastest horse. So you look at ratio charts to know. Look, this is another way to see ratio charts, guys. Let's say you owned SPX or gold, or I didn't give you the choice of cashing out the fiat. You said you could own the SPX 500 or own gold. Well, use a ratio chart. Ratio chart is going to tell you when you're supposed to swap one for the other, right? And when the trend ends, so let's say gold's breaking down versus SPX, you swap all your SPX into gold. And when gold is breaking down versus SPX, then you swap all your gold for SPX. But you'll have way more shares of SPX because you're actually creating out of thin air SPX shares by not holding them while they underperform gold. And when your ounces of gold is worth so much more shares of SPX, you switch back. And then as your shares of SPX outperform gold, on the inverse, when that cycle starts the upside, then you swap all your SPX shares for ounces of gold. US equities might not be crashing when gold and silver. That's when people say, oh, buy gold and silver only when US equities are crashing. No, you want to make sure that inflation or monetary imbalances will be created by the entities to try to nominally save US equities. Gold, silver will price in that and give you more premium on your buck. When people see the SPX and say, oh, you bearish SPX, well, the SPX has like 10 sectors or 12 sectors in it. The SPX will never go as low as its worst sector because let's say energy is only 5% of the SPX. Well, over time, if the energy sector is outperforming the tech stocks, which are going down, that's going to help alleviate some of the down of the SPX, right? You see in the Dow Jones has a lot of value instruments. It has less tech stocks maybe than the NASDAQ. So you could be bearish US equities on the indices, but if you're smart about it, you're going to go in the sectors, you'll use the heat map, you'll compare each sector with one another, and you'll want to go along the sectors that are actually all green or outperforming the sectors which are red, and you want to stay away from those, right? So that's great. Don't put everything in one bucket. There's definitely some great sectors in the SPX, but you really got to to see them, let's say in a heat map or on their chart merits. There's some that are probably going to be breaking out, on their own chart merits. So when people say they're bearish US equities, they're mostly bearish the bearish sectors in the US equities. And that's why it's fun to pick on the NASDAQ, because NASDAQ is primarily the tech stocks, that probably in there. So that's a big nuance to do, right? But overall, in a bear market for US equities, even if there's some bullish sectors in the SPX 500, it will still get dragged down. It will still underperform gold, etc. So it's still a big guideline for that, but it's not all doom and gloom within the SPX. Yeah, the best lesson: get scared, lose a little bit of money. Hopefully, don't lose a lot. Learn your lesson fast. Like get scared straight. Really get some good scares, because even with chart trading, you still have to apply sound risk and money management, because it's never 100%. Bitcoin went up 700%, or Tesla went up 10,000%. Those are big numbers. And what a new investor does is takes 10,000%. He takes whatever money he has investable in the stock market, and he multiplies times 10. Oh, look, I have 100K. Oh, look, if I would have done that trade, I would have been a millionaire by now, right? But that means you would have had to risk 100% of everything you had in that one trade. But like you said, you could have got lucky. But maybe the first time you try, like people that are hearing the stories of the guys who made a whole bunch of money with Bitcoin, if you're not lucky and you're just buying on these paradigm shift turns, your 100K will wipe you out. Your emotional capital will get destroyed. Even take fundamental guys like Warren Buffett. I don't know what's his average is, 18% per year, whatever. Professional chart traders, 30% per year. Sometimes they go down 15% per year. So if somebody's telling you that you're going to go up tenfold in 1 year, run away. Run away. It's like, that's not going to happen, guys. Even like on our website with Kevin, that's not our average. This year we did like say 19%. Previous year, maybe, I don't know what it is, 20, 30%. Those are the numbers, realistic numbers of your net asset value that could go up. It's if somebody tells you that their net asset value went from 100K to 1 million, that means they took unnecessary risk. That's what I have flashing light bulbs. The first question I'm going to ask is, how much did you risk on that trade? What if you were wrong? That's always that's a great question. What if your thesis is wrong? And people, they have such conviction in the beautiful storytelling that people talk in absolutes. Like, where's the margin for error? I'm not like charts. You could be wrong 50% of the time, 40% of the time with your charts.